Good morning, members. Morning, Forex, Mark, Evil, Bill. I think I've just said hello to you anyway in the live stream a minute ago. But anyway, how are we all doing? All back? I can't see how many people are in here. For some reason, it doesn't do a member count, but I will just crack on. Morning, Harold. Today we are going to cover robustness testing. Evening, Jules. That's weird saying morning and evening at the same time. Morning, Linus. Yeah, basically today we're going to cover robustness testing. So it's quite a big subject. However, it is quite straightforward at the same time. There's a lot of things you can do in robustness testing. And it's obviously, for me anyway, and I think for most people that develop strategies and do it and make them work, basically, robustness testing is the key. So you'll find a hell of a lot of expert advisors out there that, and you've probably come across them before, where you have an EA, they have a signal attached to it to try and sell it on the marketplace. And that signal is only 2 to 3 weeks old, or maybe 1 or 2 months old. And that's because the strategy they've developed is curve fit. And what it does is it works for a little bit, then blows the account. So they remove the signal and put a new signal up with starting again from scratch. And then it repeats the process. And it just keeps blowing accounts over and over and over again. And that's because it's a curve fit strategy, which basically means that the strategy has been developed based on the information that you can see on the back test. Yeah. So what robustness testing does is robustness testing makes sure that the strategy works with variations, or rather stress tests, if you like, within variations of strategy parameters. So things like TPs, stop losses. If it works with 10 different stop losses and 10 different take profits, you know that it doesn't matter what the market does, there's a likelihood of it working. And all the parameters within the indicators within the strategy are all tested in variances. So if you can do tests like that and over different periods of time, it means that the likelihood of the strategy working when you put it live are exponentially larger. Yeah, there are the odd strategy you'll come along across where it just works. They're very, very few and far between. But what robustness testing is designed to do is two things. First of all, give you chances to optimize the strategy and make it better. And secondly, to make sure it's got a chance of working in the future. Yeah. So a lot of people spend an awful lot of time creating YouTube videos, which you'll see out there, where they'll basically do visual back testing. So they'll get a chart and they'll go, right, okay, let's pick a random point in the past. I will look away and let's start here. Yeah. And what we're going to do is we're going to wait for price to push up and then have a big push down. And if it pushes up and you get a bear candle before that, you sell it. And if you put the order there, you need a 1.1 ratio. And there you go. The strategy is profitable. What they've just done is move back to the 17th of May in this case. Yeah. That's not long enough to test a strategy over. You need years. Yeah, because market conditions change all the time. So part of robustness testing is also about testing different periods of time to make sure that if you've got something that's worked for the last 6 weeks, great. Did it work the last 2 years in the same way? No, then it's not robust, is it? Yeah, so that's basically what it's all about. So I've got some notes I'm going to go through. As I said, there's quite a lot to cover in it. But the process of robustness testing has steps which are very simple. What you do in each robustness test will be slightly different depending on the strategy that you're testing or the EA that you're testing. And this can be done manually as well as with EAs. But obviously I do everything with EAs because manual stuff takes forever. Yeah. If you want to test 10 years manually, you're going to be there a while. If you want to test 10 years with an EA, I'll have it done in 5 minutes. Yeah. So it's mainly about testing strategies that you come up with your own EAs or with EAs that you use of mine or anybody else's. It's about testing the variances in them. So we'll start off with how to robustness test. So the easiest way to robustness test, as I say, with EAs is you just get the EA. And I'm going to put, actually what I'm also going to do is open strategy quant and load a strategy when you're ready. Where's it gone? There it is. Let me just quickly load some strategies. Where did I put them? So let me just quickly find them. 1 second. This is going to be a test. Yay, testing. Pause. ADR. There we go. Let me just stick all these in 1 sec. Okay. So I've got quite a few I want to load up just to demonstrate what I'm going to show you. Should have done this before the stream, shouldn't I, really? Yeah, basically, I've got some tests loaded here. The reason I wanted to show you this to start off with was to show you one of the main reasons we do robustness testing. So this is a test over 4 years. I'm just going to load one up. That one will do. If we look at the equity chart here and we stick the volatility on. Okay, so this bit down here, ADR, or rather the ATR. Yeah, so one of the reasons we need to do robustness testing is because we need to test a strategy over different market regimes, which is one of the most important things to do with robustness testing. So as I just said, you have a strategy which will suddenly work and you'll be like, this is brilliant. It's been going for 6 weeks and it's been making an absolute fortune. That is because the conditions in the market that you're testing, and obviously every instrument has a different ADR, is fit to that strategy. So for example, mean reversion strategies work well when the market goes up and down. When the market's going up and down, you tend to find ADR is either stable or dropping. When ADR is rising and there's high volatility, it's usually because the market, as you can see this gray line here, is trending. Yeah, you get massive spikes, which is usually things like interest rates changing, and that can either cause a very fast move in the trend or a reversal. Yeah, so your strategy, if it's going to be robust, cannot just work in one market condition. It has to work in multiple market conditions. So therefore, when you're testing strategies, you have to test them in different market conditions. So this is quite a good example, which is why I wanted to get this up. You can see the ATR here. If I just move, can I move that up? No. Tell you what I can do, actually, a better way. Let me just get ADR on a chart and show you it. That's probably the easiest thing to do, isn't it? ADR. So I make it nice and thick so we can see it. ADR 10 on the daily, right? So this is a much better way of doing it. I don't know why I didn't do this one. Right, so there's COVID. Yeah. So you can see this is the ADR of the Aussie dollar CAD. Yep, sometimes it's like this. Yep, sometimes it's going up. Sometimes it's really accelerating. Sometimes it stays massively volatile, then it moves down so it isn't. Then it moves up, and then it stays volatile, but not changing, and it moves around a lot. So your strategy has got to work when the market is doing this with volatility, doing this with volatility, and going crazy. Yeah, so you have to test it over all of these conditions. So if you go back here like this, for example, this is a daily chart. So this is, you're seeing here pretty much 1 year. If you tested your strategy over this period here for 2 months and it was highly profitable, fantastic. You have to make sure it's highly profitable this month, because this month the market condition was completely different. This thing shot off with volatility and it expanded. The range of this instrument expanded from 48 pips to 81 pips. Yeah, doubled. Yeah, so if you've got something that works, and this is why most strategies fail, if you've got something that uses pips, so you get in with a 10 pip stop loss and you get out with a 20 pip profit target, right here, 10 pips was a quarter of the average daily range of movement. Up here, it was 5% of the average daily range of movement, or 10% of the average daily range of movement. Yeah, so those variances change an awful lot. So first thing you've got to do when you're doing robustness testing is make sure you're testing all strategies over different periods of volatility. If I pick the pound US dollar, you can see the pound US dollar has had periods before COVID where it was extremely volatile, usually because of US dollar movement. COVID, it went nuts. Then we came back to periods where we were just constantly dropping. So the volatility, the amount of movement every day on the pound US dollar from December 2022 until July 2024, in 2 years, the volatility, the range it moves every day, was just dropping and dropping and dropping and dropping and dropping. Something that worked here for almost a year is not going to get the same results here, because that is not the same as that. So the way that I test with robustness is I like to do my testing in multiple parts. So we have what are called in sample and out of sample testing, and then forward testing. Okay, so the difference between the three is in sample is where you develop your strategy. So an in sample test period for any strategy or EA may be something from 1 to 4 years, for example. Yeah, so you basically will pick a period, and what I'm using at the moment for my in sample testing is from COVID, basically. So from 2020, sorry, that's not COVID, is it? That's the interest rate changes. So from 2020, which is all the way back there. Let me just zoom out. There's COVID, look, right? So from 2020 here until pretty much now, yeah, we've got a 4-year period roughly, where we've got a period where it's doing this, bit of volatility, but mostly normal, a massive run up, interest rate change, and a massive run down into not really doing an awful lot. So if you can test a strategy that works over that period of time, the last 4 years, and it comes out with a profitable equity curve, you know it works in low volatility, high volatility, extreme volatility, and very, very low volatility. Good test. But if you get your strategy working over that period, you then need to retest it. So let's go back to when it was normal before COVID, and we had periods of good and bad, and very stable volatility in the market. So a stable market regime. Yeah. So that is your in sample test. You get a proper strategy working here, and then you go, that looks good, but what would have happened if I'd have traded the same strategy out of sample? So this is where you're testing the parameters of the strategy. You're going, is the stop loss best to be 1R, 2R, 3R, or 4R? Yeah. If they all work, great. You can pick any target and know that you'd have made money during that period. But then when you pick your strategy, i.e. I go, right, I like 2R as my target, you test that out of sample. If using a 2R target on your strategy worked before the test period where you develop the strategy, you know it's robust. Okay, so this is one of the most important robustness tests that you can do, testing in sample and out of sample. The last part of testing with sample is forward testing. Yeah, and that comes in two forms. So I like to leave a period of 6 months after my testing is complete for what is my forward testing, if you like. So I develop a strategy here, I check it worked there, and then I also check it's worked recently. Yeah, so the last 6 months, are we still in either that type of market or that type of market, and are we still working? So if it works over those 3 periods, you're away. Now, in sample and out sample testing, the longer you do it, the more data you have, the more accurate your testing will be. So you can test in sample over 1 year because that'll be quick. So you can, this is something I do a lot, and you can see from what I've done here, this is a 4-year test. This is going back to November 2020. Yeah, this test that I've got here. So that produced a nice equity curve. Just get rid of that chart. Over 4 years, but it had a bad run. Yeah, you need to run this test again over the 4 years beforehand, and then run the test over the last 6 months and make sure it's still profitable. Yes, it's always going to have losses. Yeah, no strategy is not going to have a loss, but you need to make sure it works over 3 different sample periods. So that's the first test that you need to do, in sample and out of sample. Now, when you're doing a robustness test, basically what we're doing is we're using the optimizer to test the variables of the strategy. So speed of testing is critical here. So what I was just talking about, testing over a 1-year period, yeah, that's going to be fairly fast. A 4-year period is going to be 4 times the speed of that one, obviously. Yeah. So when you do your initial testing, quite often when I'm running a robustness test, I will run it over 1 year. Have I got something that's got half a chance? Looks good. Let's see what it's like over 4 years. Yeah. So this is your first test. Test it over 1 year. Does it work? Yeah. Okay. Brilliant. We've got loads of variations that are good. Test it over a longer period. Does it still work? Brilliant. Okay. Now let's test it over that, but we'll leave that bit until we've picked the settings that we want to use within our strategy. So as an example, I'm going to show you a robustness test that I did, which will obviously make this all a lot clearer, hopefully. So let me quickly run this one test. 2020, I'll go 2023 until date. Let me load this set file. So I'm doing this with the position trader EA. Where did I put it? POS test to test. No, ADR test. No, test to test. I think I might have copied it out. Hang on. That one. Load. There we go. So that test there, right? So I'm going to run this. So the way that you run a test, okay, opening up the optimizer, or rather opening up the strategy tester, get the EA properties, and you basically set the EA up to test whatever you want to test. So in this case, I'm going to use the position trader EA. Yeah, I'm going to test an RSI, an ADR based strategy where I'm getting in with $1,000 risk, $500 single target, and $750 multiple entry target. 2 entries. Yeah. And I think there was, a timed exit on Fridays. Okay. So what I want to test is it better to use distancing between trades of 1/4 of an ADR or 1.25 ADR, and I'm going to look at 0.5 increments in between. So it's going to give me tests at 0.25, and it's going to step in half ADR increments. So that would go up to 0.75 and then up to 1.25. So I want to test whether it's better to use those 3. Okay. My single target, is it better to use £300 as a target or £1,000 as a target, and every variance in between that in £100 target increments? So 300, 400, 500, 600, 700, 800, 900, and 1,000. Then I want to see if multiple trades are better to get out of at 300 to 1,000 as well. So I'm running a test to see which of 3 ADR spacing levels is best, whether it's better to use those different target levels, and also with my maximum number of trades, is it better to get out when I've got 2 trades active or 8 trades active, and I want to use 2 increments to test those as well. So I'm going to test 2, 4, 6, or 8. Okay, so there's 3 things I'm testing. So whenever you do a test, you are doing what's called strategy or system parameter permutation tests in optimization. Morning, Yusuf. So the way that we do it is by ticking this box here in MT4, and obviously same in MT5, to say, I want you to test this with those different variances. So it's stress testing the strategy. You can also test every other variance within the strategy. Okay, so for example, your risk size, is it better to use 1,000 risk? You can test whether it's better to use 1%, 2%, 3% risk, etc. Lot multiplier you can test. Yeah, so any variable in the strategy, you can test every single one of them, and it's good to run multiple tests. So in this one, for example, that I'm doing here, I'm just seeing if it's what's the best targets, how many trades should I have on, and how far apart should I space them. But I could also not do those tests and run another test where I say, is it better to use no lot multiplier or 1.5 or 2 martingale, which you wouldn't want to do, but 1.5 multiplier, for example, and I can test in 0.1 increments. So I can test 1.1, 1.2, 1.3, 1.4, etc., etc. So you can run all of these tests, and when you run them, what it's going to do is it's going to test every single variation possible of all of these settings. So we've got 3 settings there, we've got 7 settings there, 7 settings there, and 3 settings there. Multiply those all together when you hit the optimization button there. I'm just going to run this over 1 year. And you start your test, it will tell you how many system parameter permutation tests you're going to run. Okay, and I've got all these results in a spreadsheet. So I'm going to do the usual, here's one I made earlier. But I just want to watch this run so you can see how long this type of testing takes. This is being done on control points. In the bottom left of my screen behind my head, it's not even behind my head. Let me just shut this a minute and move my terminal over a little bit so you can see. So behind my head, you can see in the bottom left hand corner here, you probably can't, but that says 768. So all those inputs we just selected in the EA give 768 variations of the strategy. Yeah, so that's one strategy we've come up with, which is called the ADR reversal strategy. Means when price gets extended, you wait for weakness to come in when it gets above ADR, and you take a trade. You get out after it moves against you or goes your way. What we need to know is it better to get in at 100, 125, 150? Is it better to use 1 trade, 2 trades, 3 trades? Is it better to target a quarter of an ADR, a half an ADR, a third of an ADR, etc., etc., etc.? There are hundreds of variations, thousands of variations of this strategy, isn't there? I call it the ADR reversal strategy, but all it's saying is it stretched? Yeah, get in. But how do I get in? Where do I get out? All these questions is what system parameter permutation or robustness testing will answer for you. So this is running 768 tests on those inputs that I put in there. If you select every variable of the strategy, i.e. ADR, risk, single target, multiple target, number of trades, should I get out on a Friday? Should I get out after a certain number of hours? If so, how many hours? Should I get after 12 hours? Should I get after 24 hours, 48 hours? Blah, 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 blah. The more inputs you put in there, the more variations of tests you're going to get. If you use all the inputs, you'll probably have 1 million tests. This one test here, 768 inputs over 1 year using control points, is going to take 1.5 hours on one currency. Yeah. So this is an incredibly time consuming process, which is, again, why you see me not having 1,000 strategies to trade, because if you are going to test a strategy properly and robustness test it, it takes a long time. However, the results will give you confidence in the strategy. So I'm going to stop that test because I've done all of this testing, and I'm going to show you the results. So when you get your results in optimization results down here, let me just turn myself back on. You get this export. Okay, so this is the results screen, and on the results screen here in the optimization results, you get the pass number, which is which run. Okay, so remember we got 768 different system parameter permutation tests we're doing, 768 strategy tests we're running. Each of these passes is one test, and it tells you how much profit was made, how many trades were taken, what the profit factor was, the expected payoff, drawdown, and the drawdown percentage. And this gives you all the inputs it tested. Yeah. So here, remember we were testing ADR distance, for example. ADR distance was 0.75. Yeah. We've got one there at 1.25. We've got one there at 0.25. So this is testing different distances between trades. This is testing different targets, 400, 800, 300, 700, etc., etc. Position targets, they're all 300s and they're all maximum trades of 2, because it runs through all 768 tests one by one, changing one system parameter at a time. So what you will get is a massive spreadsheet, which you can then right click and copy all. Yeah. Now the way that I do all of my analysis is I then put this information into a spreadsheet, which you've probably seen in the live rooms before. Okay, so I'm just going to make a new tab down here and paste the results in that I've just copied, which is just basically paste. Yeah, so what I do in my spreadsheet is I have the headers up here that you will see in the test. Yeah, so we got pass, profit, trades, profit factor, expected payoff, drawdown, and then all the inputs. Okay. So in my spreadsheet is the same information: the pass, profit, trades, profit factor, payoff, and then each of these columns numbered is an individual input. Yeah. So as you can see, we were testing the distance between trades, whether I should target a set amount on a single entry, a set amount on multiple entries, and how many trades I should take. Everything else we leave as whatever it was set in the EA, didn't we? So we're just testing the variations or the system parameter permutations of these 4 inputs, and it gives you all the information. So that's basically what I do. I run that test and get the results out and then analyze it. So what we're looking for when we run a system parameter permutation test or a robustness test, basically it's the same thing, it's another way of saying it, is we're looking for robustness. So what is robustness? Robustness is a strategy where you can get into a trade and it doesn't matter when you get out, and it doesn't matter where you get out profit or stop, and it doesn't matter whether you got in there, or there, and it doesn't matter whether you used 1.5 or 2% risk. Yeah, so all the parameters within the strategy that you're testing, if you get a result where virtually all of them are profitable, in this case 768 out of 768 of those tests, individual strategy tests we did over a year, every single one of them generated a profit, it's robust. That's simple as that. Yeah. So what we're saying is, and this is one of the reasons robustness testing is important is because in a test, in any single test you run, you are not going to, in the real world, get the exact results of that test. Yeah. So for an ADR reversal strategy, for example, yeah, if your broker has a candle at the swap like that, and my broker has a candle at the swap like that, my 100% ADR level is not the same as yours. So if you run a test on your broker and I run a test on my broker, our results in that one single test are going to be different. If we say, well, if it hits that, would I have made money? And if it hits that, would I have made money? And the answer to both of those questions is yes. It doesn't matter what your broker spreads at the swap, because it doesn't matter which ADR level you use. Yeah. And we've just proved in a system parameter permutation test that information. You may well be watching your charts as this trade unfolds, and it's just about to hit your target and you see a bull candle and you close it. I am not there. I'm walking the dog and it hits my target. Someone else has accidentally deleted that and it's gone a little bit further and hit that level, and they've gone, oh, I should have taken that off earlier. We've used 3 different targets there on the same strategy using 2 different entries, but are they all profitable? If the answer is yes, yes, and yes, you know that it gives you confidence. It doesn't really matter what you target. It's just going to make money because the strategy works. The same with exits. So the 3 key things you've always got to test are the main system indicator, if you like, in this case, ADR. So I'm going to test that, I'm going to test that, I'm going to test that. I'm also going to test the 175 and the 200. But I'm also going to test the 75 just out of interest. So if I'd have taken a 75 ADR, would I have made money? Now, the test I've just done, as you probably notice, uses 125. The reason it uses that is because I found that is much better, because I've run system parameter permutation tests on levels, and this one has a higher strike rate. These have even higher strike rates. We kind of know that because it's written on the bloody chart. But the odds of that, or the strike rate on that, is 58%. The strike rate on that is over 75%. So I use that because I'd rather have quality over quantity. But I only found that out by running a system parameter permutation test on that individual input. So you've always got to test the main strategy parameter. You've always got to test risk parameters, which is your stop losses, amount of trades, drawdown levels, closing after a period of time. And you've always got to test exit targets in profit. Should I exit at quarter of an ADR, half an ADR, or rather quarter of a percent, half a percent, or whatever you want to exit at? So you test all of those, every permutation of it. And what that gives you is a spreadsheet with a confidence level. So I'm going to whiz through some of these tests that I've run just to show you the different variances. So this one here, this particular spreadsheet, I'm just going to move that up so you can hopefully see it. I've tested a system parameter permutation test using ADR 125. This is just an example. Obviously, there's a lot of tests you can do. We're using ADR 125, and I'm testing the distance and single and multiple exits and how many trades. I'm always getting out on a Friday, regardless, right? So that's the test. I've tested whether or not it works on the 5-minute time frame, the 15-minute time frame, the 30-minute time frame, and the hourly time frame. I've tested different targeting parameters as well. Yeah, so there's 8 different system parameter permutation tests that have been run here. So what we've got is a result, and I'm just going to use this one as an example. Return on drawdown is the calculation we covered yesterday, and that is basically C2 divided by G2, which is your profit divided by your drawdown amount. So it's the amount of money the strategy returned versus the amount of money it drew down onto the account. Yeah. So that gives me my return on drawdown. So the beauty of system parameter permutation testing is twofold. First of all, or rather strategy robustness testing. First, does it matter if I was an idiot or not, and I went for ridiculously long targets and I was greedy, or I was super cautious and got out really quick? No, because you would have made money regardless of what you did. Yeah. So it's a confidence thing. It gives you that, yeah, doesn't matter what you do. It doesn't matter if you get in a quarter or half or 3/4 of an ADR apart, they all work. Brilliant. Good strategy. But what I also want to know is, what impact do these inputs have on various elements? Remember, we talked yesterday or the day before, I can't remember which one it was, about key performance indicators. I want to know what impact it has changing the ADR level on my drawdown, the amount of trades I get into, and how much profit I make, and my return on drawdown. So this spreadsheet allows you to sort the columns by drawdown. I'm just going to move this back down again. Number of trades and profit. So you can, and return on drawdown. So the first thing I do is I sort it by largest to smallest return on drawdown. So what is the biggest return on drawdown, i.e. the best strategy possible? Yeah, so all of these run from 5.69 at the bottom all the way up to 6.23 at the top. Yeah, so there's 25 permutations of the system there, right? What have they all got in common? They all have, let's see if they have got anything in common. No, there's nothing really in common on any of those. Right, so there we go. That doesn't tell us anything. So let me just scroll out so I can get more of them on the screen. So what I'm looking for is basically there we go. So they're 0.75. Now, so they did have something in common. I was obviously just zoomed in a little bit. So the highest return on drawdown variations on this strategy all have an ADR of, most of them, 0.75. Meaning that it's better to space your trades further apart. That will make you a better return on drawdown. Why? Because spacing further apart gets you less trades. Less trades means less chance of going into drawdown. Okay. It also gives you a very small drawdown figure. Yeah. So we're going from 2.26% drawdown here up to 5% drawdown because we're spacing our entries apart. If we now sort this column by profit and go for what made the most money, getting in close together with 0.25 ADR makes you more money because the ones that work out, you've got more trades on. And using a profit target on the initial order of something between 6 to 8 £100 or dollars or whatever it is. We're risking 1,000. Yeah. So using a high profit target makes you more money. Logical. Yeah. On your multiple targets, always targeting somewhere between 8 to 900 as well will make you more profit. But look at what impact it's had on drawdown. The drawdown starts now at 5%. Before it started at 2 point something, didn't it? Yeah. So what we've done by being greedier is we've doubled our drawdown. Yeah. So what this testing, robustness testing, shows you is what impact things have on your strategy. There's 768 variations of the strategy we've found here that are profitable. Which one to use is entirely up to you. There's no one on the planet that can tell you which of these is the right set file because we don't know what the future is. But what it will help you with is the strategy going to work in the future? Yeah, because every variation I've tested over that period of time works. So it's a very, very high probability that at least 60 to 70%, if not all of these, are going to work in the future. But do I want lower drawdown, or do I want higher profit, or do I want a sort of medium return on my drawdown somewhere in the middle? Yeah. So what you can use this for is sorting by the lowest to smallest drawdown. Yeah. Which will give you an indication of how to achieve a small drawdown on the account. Yeah. So in this case, just happens to have a high return on drawdown as well. So let me just, it's got rid of my headers for some reason. Oh, no, I didn't want to do that. My data has headers. Why is it selecting the top? I don't know. Anyway, I don't know why that is sorting the headers. It shouldn't be. But yeah, so short. There you go. Now it's working. Now it's left that top one out. So let me just highlight the whole spreadsheet and tell it it's got headers. There you go. That should work now. So yeah, sort it from smallest to largest. Still doing that top column. For some reason, that top row's frozen. But so the smallest drawdown, basically, if you want the smallest drawdown, you spread your trades wide apart. You get out fast on your initial entries. Yeah. So these targets, remember we tested from 3 to 1,000. These are 400s, 300s, pretty much all of those are 400s and 300s. Yeah. So we need to spread our trades wide apart. We need to use 300 or 400 for our first target, and our multiple target, we shouldn't be going more than 600 to 700. These are all 400s, 500s, 300s, 600s. Yeah. So what we're saying is when we get into an ADR reversal at 125, don't get in too fast, give it room. Yeah. But when the trade plays out, get out quick. It's a scalping strategy. We want to be doing that fast, don't we? Yeah. But if I'm the sort of person that doesn't really care about drawdown and I just want to make as much money as I possibly can, you would sort it by profit, largest to smallest. So what makes me the most profit? Right, well, getting in close together makes you more profit, because when you get to 128.5 ADR, if that first one doesn't work, add more size quicker, because the chances are when it gets a little bit more extended, 125 ADR, 150 ADR, we're going to pull back quick. So get those trades close together. But also, if the first one works, hold it. If the first one doesn't work, hold it. Yeah. So what we're looking for is a big move. Obviously that generates more profit, but in turn, it's not going to have a good strike rate as the other one will when you get out quick and you space the trades apart. So your drawdown goes up. So this is what it's so good for, is showing you what the impact on your trading is going to be. If I'm a low drawdown person, I want to be using bigger spacing. If I'm a high drawdown person, I want to be using tighter spacing. So the greedy people, the not so greedy people. There's no right or wrong. It's you as a person, but there's 768 variations here and they all make money. Yeah. You can also filter this data. So if you stick a filter on it, yeah, I can say, okay, so there's my data. These are the system parameters that I'm testing. Distance, single target, multiple target, and maximum number of trades. So I want to see what impact it has if I just look. That's filtered the wrong column. There's something wrong with my spreadsheet today. Why is it filtering the lower column? So I'm just going to go over to another one. Let me go over here. This one's got a filter already in place. I don't know, there's something wrong with that one for some reason. So what we can also do is go filtering. So I can say, just show me the trades with half an ADR. Yeah. And I want to see what impact it was on the maximum number of trades, or what impact it has on the drawdown by sorting by the highest return on drawdown when I just use half an ADR between trades, or just a quarter of an ADR between trades. But you get the point. What the system parameter permutation testing is doing is saying it's good. 150 out of 160 of those tests work. But you can now see what impact everything has on your trading. So let me just quickly check my notes. Variances, yeah. So in sample and out of sample. So now what you would do with this one is, once you've got your settings, your set file that you want to test, you would then pick one. And again, this is the hardest part, picking one that is decent, but not normally the very best, and obviously not the very worst. I usually pick something in the middle. So when I usually do my picking of set files, it depends on the type of strategy that I'm testing, the type of strategy that I'm trading, but I will always sort by return on drawdown, because this is the most important thing. You're making more money than you're drawing down into in your account. I usually just scroll down a little bit and I look for something not on page one, if you like, something that is a little bit further down. And I look for something that is occurring a lot. So here I see a lot more 0.25s than I see 0.5s. So half an ADR rather than a quarter of an ADR is best. Maximum number of trades. I'm seeing way more 2s and 3s in here than I am 5s and 6s. So maybe using 3 maximum trades spaced out half an ADR apart This is the test that I did on which ADR is best. I tested from 0.75 all the way up to 150. Yeah. So I'm seeing way more 125s in here than I am hundreds and 75s. So I'll go with 125 ADR, a maximum of 2 or 3 trades. I'll pick 3 trades and half an ADR apart. That's the set file I'm going to use. Yeah. So once you've picked your set file, you then take this back into the strategy tester and apply it, and then do your out of sample test. So whatever time period we tested through, which in this case, that was initial 1-year testing, but done 4-year testing, right? From 2020 to 2024, we then need to do our out of sample test. So we're going to go from up to, in this case, I'll go to December 2020, and I'm going to start at 2016. Okay, so I'm now testing, remember, in sample and out of sample. I've developed the strategy over the in sample period. I'm now picked a set file. I like the look of that because I know it's robust. There's loads of variations of it that work, and I know what I want from a drawdown perspective, from a profits perspective, and it looks pretty good. I'm comfortable trading that. So now let's see if it worked before the testing period. Yeah. So undo the optimization and let's run a normal test. And what we're looking for now is, does that set file perform over a sample of data it's never seen? So we've tested, we've optimized, we've robustness tested, and we've checked everything over a period of time, and it looks like a good strategy. So let's check it on a piece of data it's never seen before, right? So that we can check that it's going to be profitable in that period of time as well. So obviously we're going to have drawdown. Yeah, no strategy is going to have a period where it doesn't have drawdown, because market conditions, as we just looked at with ADR, are going to change a lot. So it doesn't work very well, mean reversion, in trending time periods. That is a trending time period. Did it lose a fortune? No, it drew down by around about 15%. That's higher than what we had. Remember, 5% was our drawdown roughly, but this time it drew down by 15%, but it's now run up by 20%. So yes, it's working. Strategy is robust. It works in sample, and it's profitable out of sample. Okay. This is just one instrument, obviously. So we've tested this now on the pound US dollar. We found out it's in sample is good. We've robustness tested it. Everything's good. We've tested it out of sample. Not as good. You're never going to get the result is going to be as good out of sample, because don't forget, you have optimized the strategy within the data, within that one period of data. Not good. Look, had a bad period. What was that? It still made profit though. Yeah. Tick. Didn't lose money. You're never going to get it. I haven't finished yet, but you're never going to get it producing the same equity curve. It doesn't happen ever. I've never had that happen. It just doesn't work that way. So, but at the end of the day, as long as it makes profit, you know, your robustness testing has proven the fact that yes, this strategy is good. Now, this is before COVID. We tested after COVID. So we also need to now do a forward test on the period of data that we've never seen. So you just repeat this test. So this is a tick. It worked. Yeah, it made 16 grand. Fantastic. In our testing, we made 8 grand. So it's made twice as much profit. Fantastic. Yeah. So we've got a strategy that's robust over a period of 8 years now. And then you just run the same test again in a forward test to make sure it's worked in the last 6 months. And if it doesn't lose money, and this is the key, if it doesn't lose money, it's good. Yeah, because you don't forget, you're going to get periods of drawdown in your strategies. You're going to get periods of stagnation, as we covered yesterday, in your strategies. So, and this is just one instrument, remember. So we have an instrument here that we have strategy robustness tested, out of sample tested, in sample tested, and forward tested, that generates revenue. So now what we can do is take this strategy that we've developed and test it. That's US dollar yen. That was even the wrong pair. Right. I've just jumped ahead of myself. I thought that was pound US dollar I was testing on. It was US dollar yen. So the next thing I was going to say was, you now take that strategy and apply it to a different instrument. Yeah. If that strategy also works on another instrument, it's super, super robust because we've tested a completely different currency pair there. Pound US dollar is the one that I was meant to be running that test on. But we just saw on it on US dollar yen, you can even run it on something as crazy as US dollar yen and it still doesn't lose money. Yeah. Don't forget, we're not here to get the strategy that's spot on and make an absolute fortune and, you know, double our accounts and buy Lamborghinis and sell courses on it. That's not what it's all about. It's about not losing money because your market conditions are going to change. Your strategy isn't. So what we're doing is we're applying the strategy to different market conditions over different periods of times with different variations of our strategy to make sure it works all the time. And that's what we're just testing now. Right, so this is pound US dollar. So this is our out of sample test on the pound US dollar, yeah? The strategy that we just in sample tested and got a beautiful equity curve on. And there's your equity curve, yeah? So out of sample before COVID, it works just as well as it did before COVID. Robust. And you can test as many of these variations as you want to. So you could say, I want to pick one that's got a tiny drawdown. Then I'm going to test one that's got a bigger drawdown. Then I'm going to test one that's got a really big drawdown. That generated 42 grand over 4 years, 10 grand a year on one instrument, trading 15-minute time frames, probably once a week, maybe twice a week. Yeah. Test a really high return on drawdown set file. Out of sample test that one. Test just test different settings to convince yourself that what you've just created will also work out of sample as well. Time frame testing is one of the most important things to do as well. So when you have a strategy that you test, this one obviously is profitable, but if you have a strategy where you run tests and it isn't quite there, so you get like a small loss over the testing period, or it's just about a break even, but you see a really nice run up in it and then it unfortunately has a problem, yeah, you can try and iron that problem out, and there's two ways to do it. First way is by changing time frame. So if you run your strategy, as this case is on M15, should be anyway, yeah, run it on M15, you will get a different result on M5. So if we go back into my spreadsheet here, I always run my tests over four time periods. So if I can get it working on M5, okay, so this particular test was 160 tests, system parameter permutation tests or robustness tests, 160 of them, 128 of them were profitable. That's on the 5-minute time frame. 5-minute time frame is choppy. Yeah, so it's testing these 3 parameters in this particular case. Move yourself up to the 15-minute time frame. Yeah, I've now got 150 out of 160 tests profitable, testing exactly the same strategy, exactly the same time period, and testing exactly the same parameters, yeah, over the 15-minute time frame. So it smooths out price action, makes it more profitable, or makes it more robust, yeah. Also, it reduces the drawdown dramatically. Yeah, drawdown here starts at 5 and goes up. Return on drawdown is 3. Up to the 15-minute time frame, our return on drawdown is now 5 and down to 2.7. So we're taking less drawdown and we are more robust with a higher return on drawdown on the 15-minute time frame. Let's test the 30-minute. 30-minute time frame. We've got 150, same as the 15-minute, pretty much, but not quite as much return on drawdown and higher drawdown. Why is that? Because on a 30-minute time frame, by the time you've received your signal to enter, the market has already moved further. On a 15-minute time frame, you would have got in quicker, meaning that you can exit quicker, meaning that you're going to take less drawdown on trades that don't work. Yeah, so 30-minute time frame still works. Hourly time frame. $139 out of 160, but look at the return on drawdown, a lot lower. The drawdown's not too bad, is it? But the return on drawdown is lower because we're making less profit, because we're waiting a whole hour after we've hit ADR to get into our trades. So the market's gone. By the time we enter the trade, we've missed the move. Therefore, it's not as good. However, 140 out of those 160 tests we ran, virtually all of them, still made a profit. So robustness testing multiple timeframes gives you even more confidence in any strategy or EA that you're developing, because you know it doesn't matter what time frame you get in on, it still works the vast majority of the time. There are ones in here that don't work. So there's 139 out of 160 tests passed, which means there are 21 tests there that failed. Those 21 tests will not be massive loss. They will just not quite have got above zero. You'll usually find they sit sort of down in the 5 to 10% loss range. Okay. But don't forget, when you're trading any strategy, unless it is a single currency strategy, like a gold strategy, possibly oil, or a strategy on an index, stock index, the vast majority of strategies you're going to test are going to be trading on multiple forex pairs. So this is just 1 out of 28. You've got to repeat this test on all the others as well. And you will find on some instruments it doesn't work. So the reason I got this up is because, you can probably see, I have run that test over 4 years across every forex pair. Okay, so I've done the robustness test in sample, I've done the robustness test out of sample, and I've done the robustness test on a forward sample. I've also picked the set file and obviously had to do the robustness test out of sample of the set file I chose. And what I chose was 125 ADR. It's this set file there. It was 125 ADR, getting out after 3 trades, exiting on Fridays with a half an ADR target on singles and a 3/4 of an ADR target on multiples, right? So that's the set file that I've chosen, and these are the results. So I've run it over all 28 forex pairs, and you can see the results here. You can't see the results there, can you? Let me put them into a portfolio. And do subclasses. So you can see these are the results of all the FX pairs. There's some really crappy ones, yeah? So these passed robustness testing, but marginally, yeah? So I've picked the same strategy and I've run that testing on all of the currency pairs, and some of them just don't make money. But as a portfolio, it does make money. And there's this horrible, massive loss back in 2021 where it drew down by 20k, 20%. Yeah, this isn't shown in robustness testing, but it is shown on equity curves in Quant Analyzer, which is why it's so important to also have this. Yeah, but that's the run up on the strategy portfolio as a whole. You're going to get problems. This is the interest rate rallies, or rather drops starting and things like that. So there's bits where it's just not going to work because the market conditions are wrong. But when you do all of your robustness testing, you pick your set file and you test it on every single instrument that you want to trade it on, you can then make the decision that it does work on some and it doesn't work on others. So what I tend to do, let me just move this over, is when I've got my robustness tested strategy and I've completed it and I've got the set file and I've chosen it, I run the test over all currency pairs and look at the results. You will find confluence with your strategies that, or either your set files with whatever you're testing, that are there and very obvious, that do not make profit. So for example, here, I'm looking at the ones that don't make profit down here. New Zealand dollar yen, Aussie dollar yen, Swiss yen. Yeah, so 3 of the 7 yen pairs are not profitable. Pound yen broke even. Euro yen did make money, but is very, very low. And CAD yen did okay. Made half the profit of the best profitable pair. So you can make a decision based on that, that if you trade yen pairs with this strategy, 4 out of the 6. Is there not 7? Where's the other one? 1, 2, 3, 6. Oh yeah, sorry, 6. 7 pairs, isn't there? So we've got six pairs there where it doesn't make money. So 4 of those 6 aren't profitable. So I can remove the Japanese yen from ADR reversal strategy that I've selected and robustness tested to make sure it works pre-market, aftermarket, everywhere with all the different variations. So it's a good strategy, really good, but doesn't work very well on yens. So I can say I'm not going to trade the yens. Down here also in these losses, there's other things that you can see are there all the time as well. So we've got the US dollar CAD, the Euro CAD down there. Other CAD pairs are up in the top. So US dollar CAD and Euro CAD, kind of a break even and a small loss. Probably keep those in. The Swiss franc, Euro Swiss is down there, made a big loss. The CAD Swiss is down there, made a loss. The US Swiss, just about broke even. The pound Swiss, just about broke even. The New Zealand dollar Swiss didn't do too bad. But overall, the Swiss franc pairs, not good to trade with it, are they? So what you can do is then remove those from the equation. So let's make a portfolio excluding all yen pairs. And we'll get rid of all the Swiss pairs. Pound Swiss, New Zealand Swiss, Aussie Swiss. There we go. So there is our revised portfolio, excluding trending pairs. You off, Evil? Okay. Watch the rest of the replay. So we've still got that big loss in there. Can't do much about that. Something happened in the market back in March 2021. They changed the interest rates. We went on to about 7 to 10 day rally at ADRs we've never seen before. It's just one of those things that happens. You can't do anything about it. But overall, the strategy is robust and generates over £250,000 or $250,000. Yeah. So that's basically how you can use your robustness testing to make sure the strategy has loads of different variations that are profitable, meaning that it doesn't matter if you use any level, but there's obviously going to be some levels that are just not going to work. So for example, the 70 level you can exclude. 75 ADR for reversals doesn't work. So we're not using that one. But you can do the testing to see what does work and what doesn't work. And as long as the vast majority works when you do your testing, you know you've got something that's got a chance of working in the future. And then when you test the one that you pick on all of your instruments, you can basically filter out what is and isn't profitable. And it always is. And there's 3 strategies: breakout strategies, trend strategies, and mean reversion strategies. There's only 3 strategies that exist. I've got a video coming on that, or a session coming on that. You will always find that when you're testing mean reversion strategies, you will struggle with yen and Swiss pairs because they're safe havens. They go into huge moves, and they do not work economically the same as all other FX pairs. You will always find on trend strategies, you're going to struggle with the euro and the pound. They don't trend very much. But you'll do really well with the Swiss and the yen, and usually with the US dollar. On breakout strategies, you'll find it doesn't really matter because breakout strategies are accumulation breaks and they happen on everything. They're scalping strategies most of the time. So they will work on everything, but there will be a confluence you'll see as you develop different strategies or you robustness test different strategies that appear across all forex pairs. Gold, oil, indices will have their own characteristics. So when you're doing robustness testing, you will find that the characteristics are very clear on every single instrument that you test on. And when you do this type of analysis in the quant analyzer, you'll see that there's things that you should and shouldn't include in your portfolio. Trying to build a portfolio of robust strategies is the way that you make money. So having a variation of ADR reversals, RSI extensions, support resistance, bounce trades, opening range breakout, stock index hedge. So you've got a momentum breakout strategy, put them all together and put them into one portfolio. You'll find you get an overall equity curve that goes up. But the robustness testing is the key to the whole thing, because if you test a strategy over 3 months, like there's a guy Comment, don't know who it is. Don't even, you might be in here, but person that's posted the set file for gold in the Discord group. Yeah, when you test it, it doesn't work. He's obviously testing it on a 15k account, no problems. Yeah, but obviously hasn't robustness tested it or tested it over a long period of time, because I went back to August this year, tested it, and it just blew the account instantly. Yeah, so you've got to do this type of testing in detail with every EA. And the caveat and the problem you're going to find with most EAs, which is why I build mine the way I build them, is you can't test variables, because these EAs they sell on the marketplace and these strategies they come up with, they don't give you control over what you can input. So for example, someone puts up an ADR reversal strategy, they will basically make the trades take the EA take trades at 125 ADR. That might not be the best one, but you can't test it because it doesn't give you an input for ADR. Yeah. So for manual testing, there's always a starting point where you manually visually back test something. Yeah. But when you're doing this, you've got to go and look at things like RSI, for example. Look at an RSI on a 4-hour time frame and zoom right out and go, if I got in short at 70 there, roughly, would I have had an opportunity to get out if I'd have taken multiple positions? Yes. What if I got in at 75? What I'd have got in there? What if I got in at 80? What I got in somewhere up there? So 70 works, 75 works, and 80 works. That's one test, one trade. So that is a system parameter permutation test you've just done manually. Here you can do the same thing. If I got in at 70, would it have worked? No, because it pushed up. If I got in at 75, would it have worked? A bit later. If I got in at 80, would it have worked? First time. Yeah. But would it have worked at all three of those levels if I'd have position traded it and held it for 5 weeks? Yes. That is a system parameter permutation. That is robust. It doesn't matter which of those you took. It worked. Yeah. So this is what we're trying to find, and robustness testing helps you find indicators and strategies that work regardless of the input. If you find something that only works at 70 and never works at any other level, that's not robust, because you're not going to get that. And the reading here on your chart, and this is a very important point, the readings on your chart are from your broker. Your broker's data varies from broker to broker. Therefore, the instruments on it, which are calculated from data, vary. Yeah. Some brokers stopped out at break even on the FTSE. Some brokers include pre-market data on their indices. Some brokers start at 7 o'clock, and that's the only data you get. If you run a test on that broker and the broker that gives you different data, you're not going to get anywhere near the same results. ADR would be in a different place. Your moving averages will be in a different place. Your RSI will be in a different place. Every reading will be completely different. So this is what system parameter permutation and robustness testing is all about, is testing tolerances. So if you can test that and 10 to 20% above it and 10 to 20% below it, and somewhere in that range, if you do something, it works, you got a strategy. That's it. Let me just check there's nothing else I wanted to cover in that one. Filters. Yes, filters I wanted to cover. So, for example, here, this is the last bit. We got a problem. This is a robust strategy. I've forward tested it, back tested it, in sample tested it, out of sample tested it. I've tested it on multiple currencies, but it always makes a massive loss there. How can we filter that? So again, robustness testing will also identify, or system parameter permutation testing, whichever you want to call it, areas for improvement in strategy. So there may be one of those robustness tests that doesn't cause that. And the only way you're going to do this is to further test it. And again, it's all very time consuming, but it's important to do. That big loss there is caused on the 24th of February. So 2021, that'll be, won't it? Here. Yeah. So we suddenly start taking tons and tons and tons and tons of loss. Yeah. But it happens on every single currency. Pretty much. Yeah. You can see they all, not all of them, but some of them have a really big, massive drop there, don't they? So there may be some that don't. Aussie dollar CAD did. Aussie New Zealand didn't. Aussie US did. Euro odd didn't. I can tell you what's going on. US dollar and CAD. Yeah. Euro CAD did. Euro US did to a certain extent. But there was some movement that caused that big drop. So what you can now do is go, okay, this strategy looks fantastic. The portfolio is great, but every now and again we get these huge losses, and they've only happened 6 times in 4 years, but there was one really big one. So how can we filter this out, these problems? I mean, how can we get rid of these problems? Well, obviously we need a backup, don't we? So we can say in our testing, what if I said if it gets to $1,000 in loss, we shut it regardless. It doesn't matter if it's 1 trade, 2 trades, 3 trades, 4 trades. It doesn't matter if it's 1 ADR, half an ADR. It doesn't matter if it's Friday, Tuesday, Wednesday. If it gets to 1,000, we just shut it, because we know that there are times where the market goes completely parabolic on some kind of news, moves 400 ADR, and if we've taken an ADR reversal, we're just going to hemorrhage cash. Backup plan, aggressive drawdown control, things like that. Yeah, so you can use the robustness test to find something that works, test it, and then in here you can say, right, there's problems. So what can we do with it? List of trades. Let's look at our maximum profit and loss. That's maximum profit, maximum loss. Why are you not filtering? There we go. So we've got trades here. We want to find the ones around about that February level 21. There we go, there's one there. So $1,000, that was the maximum loss. So that type of exit you wouldn't be able to use, unfortunately, in that case. But you can look at all these and go, right, well, these 2.5 grand losses, these 2 grand losses, there's all these losses. So the vast majority of these losses here, you can look at time in trade to try and filter by time in trade. You can look at adding potentially moving average filters, but I wouldn't do that with a mean reversion one. But you can add a maximum loss in there of, say, $1,000, like I just came up with. Yeah, and what it will do is it will remove that and turn all of those into thousands. So it's not going to be able to say we can't get rid of it, but what if we can halve it? But you've got to then do your system parameter permutation testing again in your EA, and you're going to have to set a maximum loss in there. So in the position trader EA, we could say if we get to 1%, so we can use drawdown control. If we get to 1% in loss, we close out 100% of the trade. So that is equivalent to 1,000, is equivalent to 1% for me. But you would just set that to 1,000 and say, right, get out. And that will then remove all of those huge losses or reduce those huge losses. And then we can run that test again. Is that the same? That's not the same period, is it? So I'm just trying to see where that loss was. Oh, this is this is the test we did out of sample, isn't it? So, but you can run it again. So retest it using that new input and see if that helps reduce the losses. But it also, you need to make sure it doesn't hinder the profits, because some of those trades that may have gone into 1,100 drawdown turned into 1,000 profit. So by adding that extra one in there, you're also removing the profit that would have been generated off of that trade. Look, that actually made it worse. So we had a period there where using that made it worse on this particular instrument. So That's not a filter to use. And you will find there's times where you just can't get out of these. You can't get rid of it. Unfortunately, it's just loss. You've got to take it. I have losing months, as I said, but overall, yeah, it's good. It makes a load of money, doesn't it? Any questions on that? So it was a bit of a heavy session, I know, but it's a very important one because, and you can do it to any extent you want. Yeah. Robustness testing, but you've got to do it in some shape or form because you are never going to get the exact market conditions replicated again that you do in a back test. So you have to test variances of it. Something else as well I forgot to mention as well, we touched on it the other day, was spread. You know, so one of the system parameter permutation tests, the robustness test you can do is to make it robust, it needs to work if I've got a spread of 2 pips or 5 pips. Yeah. So that's another one you can run. Yeah. So does it make profit there? Does it make profit there? Yes. Yes. It's robust. Yes. No, it's not robust because your broker may change your spread in the future on this instrument to 4 pips. You're not going to get the same result. Or are you? You probably will. And you know why? Because if you target $300 profit, $400 profit, $500 profit, and $600 profit, and they all make money, it doesn't matter if you're using 2 or 5 pips because all you're doing is you're getting in slightly later, but we know that going slightly further than the target still makes us money. So that system parameter permutation test that showed us it was robust to use any profit target makes that one redundant. Yeah, doesn't it? And this is why the more robustness tests you do and the more you get out of them that come out with numbers up here, which are high, the higher the probability. Getting a maximum is quite rare. You know, this test I've got here, which is 768 by 768. So the 768 tests run, every single one was above 0. They are not rare, but they are less likely to happen. More often than not, you're going to get 720s, 680s, you know, numbers which are within 10% of the maximum. 15 maybe is probably not a bad one. This one here, for example, running on the 30-minute time frame, this test gave me 384 out of 768. So this is a robustness test I've run on the strategy to say, is it better to use 5, 15, 30 or hourly? The 5 gave me 720 out of 768. The 15, 768 out of 768. The 30, 384. So getting into mean reversion scalping strategies intraday on the 30-minute time frame, it's not good, is it? Why? Because it's already happened. You missed the move. You've waited 30 minutes for the move to happen and then gone, no, get in now. No, 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 you missed the move. It happened up here. That's why it doesn't work. Hourly, no, it's not good. 400 of them worked. 768 tests. So pretty much half of the time, it's not going to work in the future. That's the way you need to look at that number. Yeah. If you get a 768 out of 768, it's hard not to make it work because we've just tested, if you think about it, 700 random strategies, 700 random variations on something of pressing a button and entering in a direction and getting out at some point in the future, whether it be this, that, or the other. They all worked. That's pretty good. If only half of them work, there's half a chance in the future it's not going to work. Yeah, that's what it's showing you. So there's multiple elements to it. And it is quite complex and it is quite in depth and it is very time consuming, but it's the only way to be sure you're not going to waste your time. And one of the reasons I believe people system hop is that they do not invest any time in this. You will get a strategy, you watch a video, you go back 2 months, you test it visually and you go, thing's got 100% strike rate. Yeah, it might have had 100% strike rate in the last 2 months. But what happened 2 months before that? Not interested. I'm just going to trade it. Well, why didn't it work? Well, because you only looked at 2 months. How long are you going to be trading for? Just 2 months, or are you going to be trading for the rest of your life? Don't you want to check a bigger time period and make sure it actually worked then as well? If you don't do that, you're doomed to failure. And all you're going to do is you're going to system hop, system hop, system hop. And you're going to keep system hopping. You're not going to stop system hopping, because everything you look at, if you don't look at it over a big period of time and test it thoroughly, you're not going to get there. One of the videos I'm going to do, one of the sessions I'm going to do, is on the 3 strategies, which I just quickly covered as well today. Yeah. There are only 3. Yeah. Mean reversion, range, breakout, and trend. Yeah. There's only 3 strategies. There's only 3 risk criteria you can get into. You can either get in with a stop loss, you can dollar cost average, or you can exit on time. Yeah. And that applies to targets. You can either get out after a distance, you can get out after a period of time, or you can get out with multiple trades after a period of time or a distance. There's only 3 strategies. There's only 3 entry and exit criteria. Put those 2 together, there are only 9 strategies in existence on the planet. Yeah. So when you do this system parameter permutation testing and robustness testing on 1,000 strategies, you're going to get the same results on all of them, because it doesn't matter if you use a Bollinger Band, an RSI, a CCI, or a MACD as your extension indicator. Robustness test all of them. They all work within a period. Exiting in a profit all works, yeah, within a period. So this is why I've come up with the strategies that I've come up with, because I've tested everything. Everything works and everything fails, but it's about finding something that works more often than not based on random market movement. That's how you generate profit and extract it from the market, because anything with a stop loss in here, I can guarantee you go and find me a stop loss strategy, or we can make one with a position trader EA, market reverse alerts EA, opening range breakout EA, any EA that I've got. You put a stop loss on it, you will find it virtually impossible to get anything above 50% there, because the market is random. Yeah, it doesn't work. Yeah, it's just the way it is. You cannot robustness test, and sometimes you can get just over 50% with it, but it's really, 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 really hard. So great session, very in-depth look at variables. Yeah, very nice. Always saw those settings and didn't know what they meant. Yeah, so that it's something you've got to be aware of. It's very important, basically. But the optimization, go and play with it. If you've got any questions, chuck them in the Discord channel, and I can always cover it in another session in more detail. There are a lot of ways to do this as well. You know, when you look at my EA, for example, this is the position trader EA. I don't know how many inputs there are, but every single one of these is a potential parameter test. Yeah, so drawdown control, use it or don't use it. If you do use it, should you use 0.1 and in 0.1 increments up to 3? Which is those are the best to use? And out of those, is it better to close 10%, 20%, or 100% of the order and every variable in between? Yeah, that test there alone, just those 2 parameters, is probably 15,000 variations. I don't know. Let's show. We can run one and test it. Let me undo these. But this gives you an idea of how time consuming and complex it is. So if we just wanted to test, is it good to use drawdown control, and in 0.1 increments, that's 3. Yeah, I mean, we might want to. I mean, you're not going to go 0.1, are you? You'd probably start at 0.5 and go in 0.25 increments. You wouldn't be that aggressive with it. But closing out somewhere between 10 to 100% of my trades, yeah, if you run that test over a year, let's go 09, that'll do, 2023. Yeah, so just testing those 2 inputs with multiple variations over 1 year, you'll probably find this comes out at a few thousand tests, and will probably take 5 or 6 hours, maybe. Oh no, 110. That's not bad, actually. So that's going to take the 110 tests. So that's only going to take 10 minutes. But if we include, should we or should we not use it? Yeah. And then we include the should we use or not use maximum number of trades and somewhere between 2 to 8. If you retest that, we've now got 5 variables being tested. The number's going to jump exponentially, like something nasty. 1,760 tests we're running now, 3.5 hours. That's all this test is going to do is go, is it good to use drawdown control? If so, how much? That's it. So this is a drawdown control test on one instrument over 1 year. It's going to take 3.5 hours. I have a VPS with 5 terminals on it, and I will test multiple variations with 5 terminals on a VPS so that I can run many of these tests at a time. If you just do it on one terminal, you will be here for a long time. But if there's just one thing you want to know, that is what robustness testing is for. Yeah. So you've got a strategy, you've been trading it, you've been position trading ADR reversals or something. You're like, am I getting out too soon? So over the last 6 months I've been doing this, I've been getting out with 1/3 of an ADR. What would have happened if I'd have got out with half an ADR or 1.5 ADR and variations in between it? You can find out. And if you find that they were all profitable and you look at it and you sort it by return on drawdown and you find that you were getting out of 1/3 of an ADR, and if you'd have just let it go to half an ADR, you'd have doubled your P&L and your drawdown would have gone up by 0.5%, you know that's what you should be doing. But because every single one of those variations is profitable, you know it doesn't matter which you pick, you're still going to make money. So you've got robustness. If when you run that test, you getting out at 1/3 of an ADR makes money, but getting out at half an ADR, 3/4 of an ADR and 1 ADR don't make money, you know you're doing the right thing. Yeah, so you can also use it to fine tune what you're doing, robustness and optimization. It's got so many words. I don't know why we have so many names for the same thing. Some people call it robustness testing. I've always called it system parameter permutation testing or SPP testing. They call it optimization. Some optimization I call curve fitting, making something profitable on the chart. That's not how it's going to work long term, is it? There we go. Anyway, so that's that done. If you've got any other questions, chuck them in the Discord channel. If there's anything else you want to cover on it, let me know. If you want to do some more of it, if there's specific tests you want to run, anything like that, let me know. We can do it. If you've got strategies, obviously, you want developed as well, let me know. Tomorrow, I have planned to do a session on what was I going to do it on? Prop strategies. Yeah. So tomorrow's was going to be strategies for trading with prop firms. This is something I kind of put together as a video that I was going to do. And it's more about how to make money out of prop firms and the types of trading that you need to do on prop firms. So I'm not sure whether I really want to do it as a session. So if you can let me know, either comment if you're watching on replay, or let me know in there whether you want to do that or whether you want to just skip to exit methods for specific strategies, which is again part of what we've been doing today. Is like I said, there's not many ways of getting out the market, and there's different ways of different strategies obviously require different exits. So there's a video that I'm going to do, or session I'm going to do that on Friday, but I might move that forward to tomorrow and do something else on Friday. But if you want to do the prop one, yeah, I mean it's worth covering, I think, but don't expect me to be massively positive about it, as you probably know. Not a fan of prop, But I will tell you why and the strategies that I think you will find that will work on prop, and some of the ones that I've traded on prop very successfully, and what you can't do basically. But that kind of ties, the reason I put it there is because it ties into Friday's session of exit strategies, because you do need a specific type of exit on prop to be able to actually make money out of it. So we'll leave it as it is for the moment, but if you don't fancy that, then we can always switch. And if there's anything else you really want, if there's any burning content that you're like, I really want to know about, then let me know. We can always move these around. They're not in any specific order. The whole point is it's interactive. So rather than just listening to me waffle on, which seems to be what's happened today, but that's probably because people haven't got questions, which is fine. But anyway, I will leave you there. Back tomorrow, same time, and we'll cover that unless anybody wants to change stuff. If you're trading the DAX and stuff with me today, it's unfortunate. I should have taken profit up there. It just missed my target by kind of that much. And I've got a hedge on here, so I'm just going to let that run and see if we can get an ADR out today, because we've got news later. But other than that, loss morning, not massive loss. We'll see how we get on with the US this afternoon, but meh. Okay, have a good one. Anything you need, let me know in Discord. Other than that, I will see you guys tomorrow. Have a good day.